morning, everyone. My name is Bogyung-chae, and today I'll explain Chapter 2. I'll briefly explain what the forward and futures contract, and then I'll going on to futures contract. What do you think the futures contract? Yeah, contract to buy or sell the underlying asset on specific day with predetermined price. And actually, futures and forward contract are really similar, so I'll go on to this page first. The difference between forwards and futures are like that. And so forwards are contract privately between two parties, and futures are traded in exchange. And forwards are non-standard contract, and futures are standardized to trade in exchange. And forwards usually one specified delivery day is different, and forwards are usually one specified delivery date, and futures a range of delivery dates. And forwards are settled at the end of contract, but futures are settled daily. So this is one of the most biggest difference. It is called mark-to-market, in other words. And in forward, delivery or final cash settlement usually occurs, but futures contract usually closed up prior to maturity. And forward, it is privately traded, so it has some credit risk, but futures virtually have no credit risk. And then I'll go to and then I'll explain futures contract. Futures are available on a wide range of assets like commodity or financial assets. All the other things can be an underlying asset of the contract. And as I said before, futures contracts traded in exchange, and specification need to be defined. So what can be delivered and where it can be delivered and when it can be delivered. And it is settled daily. As the settlement day comes, futures price converges to spot price. If the futures and spot price different on the settlement date, there can be arbitrage opportunities, so it should be the same. The margin is to prevent the counterparty breach the contract, or counterparty does not have the money to 뭐라고 했지? 계약을 이행할 자금이 없을 경우를 막기 위해서 하는 건데요. A margin is cash or marketable securities deposited by an investor with his or her broker, and the balance in the margin account is adjusted to reflect daily settlement, and margins minimize the possibility of loss through a default on a contract. And there are the initial margin is the margin you have to pay when you initiate the contract, and so it's like this amount. And maintenance margin is the margin you should main the amount of margin you should maintain. So it's like this amount, because I said that the balance in the margin account is adjusted to reflect daily settlements, so it can be like this, and then and suddenly it goes on to, when it goes down to maintenance margin, then you'll get the margin call that you are requested to send additional margin, and then you should pay the additional margin to like this amount, and it is called variation margin. The next is example of futures trade. An investor takes a long position into December gold futures contract on June 5. The contract is like below, and then look at the table next page. There is a possible outcomes. So the first day the trade price is 1,250, and then the price change daily, so settle price on the next day on the next day is different, so you'll get the daily gain or loss, and it changed your margin balance, and like day 7, when your margin balance below 9,000, like in this, you'll get the margin call, so you'll pay the variation margin on that day. And the clearinghouse, it takes role of intermediary that guarantee the counterparty to make sure to 거래 이행을 보증하는 거예요. 그래서 so when futures price increase, then long trader gets gain, so short trader send some amount of margin, and it goes to broker, and it goes to clearinghouse member, and to clearinghouse, and the opposite way, and this way. The opposite is also the same. And some terminology in futures trade is one is open interest, and it is the total number of contracts outstanding, and it is equal to number of long positions or number of short positions. It is different from volume of trading, and the volume of trading is the number of trades in one day, and the settlement price is the price just before the final bell each day. So it is the last price of the day, and it is used for the daily settlement process. And key points about futures are the futures are settled daily, so it is called daily settlement or to market. And futures closing out the futures position involves entering into offsetting trade. So if you have a long position in futures, you have to sell the contract to close out your position, and most contracts are closed out before maturity in futures market. It is the example of crude oil trading on May 26, 2010, and open is the first price of the day, and high is highest price of this highest price, and low is lowest price, and settle is the settlement price at here. And change is the change between other days, and volume is the number of trade on that day, and open interest is here the total number of contracts outstanding. And collateralization in notice markets is similar to margin to prevent credit risk in OTC market. They use collateralization, and it is becoming increasingly common for a transaction to be collateralized in OTC markets. And consider transaction between companies A and B. This might be governed by an ISDA master agreement with a credit support annex, and ISDA is International Swaps and Derivatives Association. The CSA might require A to post collateral with B equal to the value to B of its outstanding transaction with B when this value is positive. So it is similar to margin. And collateralization in notice market is if A defaults, B is entitled to take possession of the collateral. The transactions are not settled daily, and interest is paid on cash collateral. There is an example of long-term capital management in the textbook. And have you heard about long-term capital management? Yeah. Long-term capital management is really famous hedge fund, and Scholes and Merton and of Blackshirt model. They was also the member of this hedge fund. They use many strategies, and one of the strategies they use was convergence arbitrage. Imagine two bonds, X and Y. Those cash flows are similar, but they're liquidated liquidity on X bond is low and the liquidity of Y bond is high. Because market values more on liquidity, so the the market price of bond Y is higher than bond X. And LTCM uses the strategy that using LTCM 한국말로 LTCM이 이 리퀴디티에 따른 시장 가격의 차이를 이용해서 전략을 짰어요. 간단하게 설명하면 이 리퀴디티가 낮은 X 같은 경우는 매입하고 리퀴디티가 높은 Y를 매도해서 미래 일정 시점에서 두 채권의 가격이 같아질 것을 기대하면서 거래를 한 거예요. 근데 98년도에 러시아가 모라토리움을 선언하고 그때부터 이런 X와 같은 유동성이 낮고 좀 불안정한 채권보다는 유동성이 높고 안전한 US 트레저리 같은 채권의 가치가 상승하고 가격이 올라간 거예요. 그래서 이 X랑 Y의 가격 스프레드가 굉장히 커지게 되고 그래서 됐는데 거기다가 이 LTCM이 자신들이 갖고 있는 채권에 대해서 담보를 이렇게 내놓아야 되는데 이 LTCM은 되게 많은 차입금을 사용했고 레버리지가 높아서 이런 담보를 제공할 만큼 충분하지가 않았던 거예요. 그래서 LTCM은 결국 파산을 하게 됩니다. 그리고 그런 유동성이 높은 안전한 채권을 선호하며 이동하게 되는 현상을 Flight to Quality라고 해요. 그리고 and clearinghouses and OTC markets. Traditionally, transactions have been cleared bilaterally in OTC market, but after the financial crisis, transactions to be cleared centrally through clearinghouses like exchange. This is the left one is bilateral clearing, and the right one is central clearing. So yeah. And the delivery, if a futures contract is not closed up before maturity, it is usually settled by delivering the asset underlying the contract. When there are alternatives about what is delivered, where it is delivered, and when it is delivered, the party with the short position chooses. And few contracts like stock indices and euro dollars are settled in cash. And when a new trade is completed, what are the possible effects on the open interest? What do you think? The first question. It can be increased or decreased or remain same. It depends on the situation, actually. And can the volume of trading in a day be greater than the open interest? Yeah, actually it can be. The trading in the contract was exceptionally high on that day, then that kind of situation can happen. And types of orders, actually, I think it is not that important in this class. So I skip. And regulation of futures. Actually, I think those regulation and counting and tax things are not that important in this class. And this is the page I explained before, and foreign exchange cuts. Futures exchange rates are quoted as the number of US dollar per unit of the foreign currency. So, and forward exchange rates are quoted in the same way as spot exchange rates. This means that euro or the another dollars, another currencies are quoted as US dollar per unit of foreign currency. Other currencies are quoted as units of the foreign currency per US dollars. And this is end of presentation. Thank you.
Implement, it is very easy homework. I think you did this homework before in the financial econometrics class, but anyway, homework. Implement following Black-Scholes button formula with R. Print out, submit your source code by next class. Email submission not allowed. All student will be randomly selected, okay, to demonstrate his, her, or her program. It is because on the web there is a solution like Black-Scholes formula with R. Black-Scholes in R, right? There is even solution on the web, right? So, but I don't want you to simply copy and paste this one and submit this. This is, I don't think it doesn't help you at all. And actually this one is slightly wrong, slightly incomplete, because this one does not take into account the dividend. So you should not copy and paste this one, because in our homework we have dividend RD. Okay, so slightly different. But anyway, there is a solution, but you have to demonstrate this next class. Yes, of course. That's the easiest way to do the homework. You know, so it is like defining R function. So there is solution anyway. And then there are other Black-Scholes difference between VBA code and R code, the Black-Scholes option press. So anyway, it is very easy homework. And about R, you know, then some of you maybe never heard of R. Therefore, there is a resource. You can click the resource. Wow, there are a bunch of online lectures about R. You know, on introduction to R, or brief tutorial intro to R, blah blah blah. So go to YouTube and click one of it, and you will learn what is R and how to install R on your computer and how to start R. Let me briefly demonstrate you, okay, how to install R. In order to install R, you have to download R, right? And fortunately, R is open source, completely free. And actually, even though it is free, it is a wonderful, efficient program. When I worked in Lehman Brothers, I developed professional trading strategy with R. Okay, so it is a professional tool as well. And many hedge funds also use R. Good news, right? It is free, though. In order to download R, first you simply type R in the Google, okay? Google.com and R, right? Then modular gas constant. It is definitely not important. And then R project for statistical computing. You go there. And then, of course, you have to download R. And then go, new version, blah, blah, blah. And then, where is download button? Download packages, CRAN, okay? And then you download whatever place you wanna go. You can go to France, your home country, Rory. For example, you can download it from France, I think. Right? You can download it from France, or you can download it from Korea. Okay, there's a Korea. Jungang University. Next are corporation. Of course, you can simply download it from cloud. And then download for Linux. I use Linux at home, but our PCs are not Linux. Our OS is not Linux, so skip. If you use Mac OS, you have to download this version. In this class, this is Windows 7, therefore I download R for Windows and install R for the first time, right? So easy. And then download R303 for Windows. Now it is downloading. And then start, run. Let's install in English. Okay, click, 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 click. Extracting file. Completing the R for window. Done. Right? R is now installed. So let's start R. So R. Oh, it is in Korean. So how can I change language setting in R? Okay. Change language setting R. R console in my native. How can I set R to English? Okay, so clearly it is in Korean, so I want to change this one in English. R version file, language, EN. Yeah, but I want to successfully adding R home etc. On a fresh install, start file, R language in RS, R console file. R profile, R console file. This is strange. How to change language setting in R? Yeah. What is it? It is a R. It is a program. Yeah, it is a program for your homework. Yeah, yeah. So you have to download R as I did and install in your PC and you have to. So this is what I don't want to be by so-called industry expert when you go to the industry graduating Hanyang University. Okay, when you hear someone say about trading strategy, creating alpha, then you have to always instantly suspect whether that is really tradable, whether there's a limit in the trading. Okay? And then today I tell you about the framework of assessing those claims, limit of arbitrage. So, example with low volatility. Download. Direct download. Okay. Limits to arbitrage and the low volatility anomaly. This is very interesting topic. So it is another academic paper. It's academic paper. If you are interested in PhD or master's program, you have to write something like this. The title of this paper is The Limits to Arbitrage. Last class we learned about tax arbitrage. Now it is some sort of limits to arbitrage. And then it is about low volatility anomaly. And what is low volatility anomaly? What is the limits to the arbitrage? We will see. It is written by a professor at Hong Kong University Science and Technology and CFA Institute and Florida Atlantic University. Good. Okay, let's read the abstract together. We show that over a long study period, 1963 to 2010, the existence and trading efficacy of the well-known low volatility stock anomaly are more. So there is a phenomenon called low volatility stock anomaly. Some people argue that we can make money using this low volatility stock anomaly. And the authors argue that those anomalies are limited, more limited than widely believed. For example, we find that the anomalous returns are not found within equal weight long-short portfolio. Last class we learned long-short portfolio, right? We took long position on the high tax change portfolio and short position on the low tax change portfolio. Then we can create some excess return, right? We can make money. That was example long-short portfolio. In this case, there is a similar long-short portfolio, low minus high. Take a long position on low-risk portfolio. Take short position of high-risk portfolio. Okay. Some people argue that such strategy can make money, but they argue that it is limited. Okay. Within value-weighted portfolio, the existence of alpha of this strategy is largely eliminated. Okay, go away when omitting low priced, less than $5 stock. It's called like penny stock. So if we exclude penny stock, this anomaly disappear. Penny stock is like in the Wolf of Wall Street, and Leonardo DiCaprio was fired because of the Black Monday, and he goes to some shady places. And it is a place where people trade penny stocks, right? Did you see Wolf of Wall Street? Only one. I told you to watch that movie. You should watch that movie. It's very educational and exciting, fun movie. Wasn't it interesting? It's just very interesting movie. You have to watch if you are interested in finance sector. And you are taking this class because you are interested in finance sector, right? Therefore, you have to watch that movie. Anyway, when omitting low price stock. Furthermore, extracting any excess returns are associated with long-short portfolio is meaningfully hampered by high transaction cost of trading. Okay, reflecting the finding that the abnormal returns are concentrated among low liquidity stock. Low liquidity means it is hard to trade, and small risky stock. Adding to the challenge, the anomalous excess return quickly reverse, requiring traders to rebalance frequently. Okay, so in order to execute trading strategy upon low volatility anomaly, traders trade a lot. Whenever they trade, it is costly. Okay, trading is costly. Therefore, a lot of trading means trading profit should decrease. And then not only decrease, it reverse. Okay, it reverse. Positive will become negative, requiring traders to reverse in attempting extract profit, thus amplifying liquidity needs. Our finding have meaningful implication for those attempting to implement low risk equity portfolio strategy. In Korean financial sector, 여의도, there was once boom. I'm not sure whether it is still boom or not. It was a boom about 저변동성 주식, low volatility stock, and some financial institutions try to sell a product called 저변동성 상품, low volatility stock. That is exactly this strategy. And this paper argued that those strategies are useless, basically. Why useless? We will see. Highlight. In what is sometimes referred to as a low risk or low volatility anomaly, researchers have discovered a provocative empirical inverse connection between future stock return and various measures of stock return variability, including total return volatility. So it is total return volatility. It is simply standard deviation of stock return past stock return. Idiosyncratic volatility, it is, last class I told you idiosyncratic risk, right? Systematic risk and idiosyncratic risk. Inverse connection, right? It means that if we have high idiosyncratic risk or basically high variability, we have low future return. Isn't it interesting? Why is it interesting? If a stock return is highly volatile, we expect low future returns. Right? That's what people found. It is interesting. Why? Why is it interesting? It is interesting because people think the other way. People think that if there is high volatility, they think future expected return should be higher. But in reality, it is low. So people are surprised. Why it is surprising? Why? Exactly. Risk return relationship, right? High risk, high return. That's our common sense, right? So there are a lot of ways of measuring risk, but let's say idiosyncratic. So it is highly volatile. So, if we compare low volatile stock and highly volatile stock, intuitively we think highly volatile stocks are riskier. So because high risk, high return, they should generate higher return. Otherwise, people don't want to buy that kind of stock. But in reality, in data, people found high variability and low future return. So it is very, very interesting pattern. It is interesting, right? And people still cannot understand why this happens. But anyway, regardless of the hidden economic reason, that is a very interesting topic. So let's focus on this phenomenon. Just focus on this phenomenon and think about way of making money. This is such an interesting pattern, right? High risk, low return, right? It's such an interesting phenomenon. So people call it as a low volatility anomaly. It's anomaly because it's a strange phenomenon. In this article, we seek to further explore the anomalous low risk returns in an effort, okay, to better understand the underlying economic question of why this happens. This paper basically wants to investigate why this pattern occurs. But actually they cannot answer this question. They just hint something about this, but they couldn't answer completely. But anyway, they want to explain this famous puzzle, right? Famous anomaly. And then basically their conclusion, we examine what role portfolio rebalancing. Portfolio rebalancing means that when they have a portfolio, sometimes they want to change portfolio way, right? They want to buy something more, they want to sell something more, something like that. Rebalancing portfolio. We examine what role portfolio rebalancing and transaction cost way in attempting to extract profit from the low risk anomaly. Okay, so it is a very strange pattern, but instantly the low risk anomaly, which says that high risk, low return, right? What else? We don't know why this happened, but instantly it suggests a strategy of making money, right? How we can make money? What is the most intuitive, obvious trading strategy out of that low volatility anomaly? Lori, if we believe, I don't know why low volatility anomaly happens, but let's believe low volatility anomaly is true, then how we can make money? How we can generate profit? You know, so high risk, high volatility stock generates low performance, which means low volatility stock generate high performance, good performance. Yeah, it is strange, but I don't know why this happens. I don't know why. Yeah. Yeah, anyway, it is very, very strange. But let's say it is true. We don't know why this happens. But if that is true, then how we can make money? Which stock we have to buy, and which stock we have to sell? That's an idea, okay? Low volatility stock generate good performance. So we simply buy low volatility stock, low risk stock. And we have to sell high risk stock, right? That's obvious trading strategy. And then the author want to examine that trading strategy from the perspective of how much we have to trade and what is the cost of trading or cost of implementing that strategy by cost high variability, high volatility stock generate low return. So we sell high volatility stock and we buy low volatility stock. And they want to examine how much we have to rebalance. Okay, how much we have to pay to actually attempting that trading strategy. So it is a very, very practical question. Yeah. Good point. Okay, so we have to measure high volatility and low volatility stock, right? We wanna sell high volatility stock. We wanna buy low volatility stock, right? And how do we know what is low volatility and high volatility stock? It is simple. You download past stock prices, and some moves like this, it is high volatility stock. Some moves like this is low volatility stock. So we sell stock with this kind of movement, and we buy stock with this kind of movement. We have you can do that by watching the pricing pattern. That is one idea. Another idea is, of course, you can download and you can calculate standard deviation of past like 1 month, something like that. Or you can do something like that. You can download data and then you can do something called regression analysis. Regression analysis, and then basically you calculate the regression analysis means that you calculate this part. Once you calculate this part, you have only this part, and then again same, you have only this part, and you calculate past 1 month standard deviation of this one, something like this, and sort stock, and stocks with variability we sell, stock with low variability we buy, something like that. There are many, many ideas, but basically idea is simple. You simply watch the pricing pattern, you sell this kind of thing, and you buy this thing. Idea is straightforward. But then question is, okay, Is it really profitable? It looks profitable, but when we actually buy and sell, it is really profitable because we know we have to pay money whenever we have to buy or sell. We have to pay our brokerage fee. When we sell, we have to pay tax or something like that. Okay? It's the question. Okay? And then let's go to the conclusion of this paper. We find that the excess return associated with forming the low risk zero cost portfolio are short lived. Okay, our the strategy of buying this one and selling this one. Okay, if we match exactly same amount dollar amount of buying and selling, it becomes zero cost. Okay, are short lived. Okay, that profit doesn't last for long, as they are priced only in 1 month T plus 1, and furthermore are largely subsumed by high transaction costs. So it is bad news. They seemingly generate profit, but in order to generate profit, we have to trade a lot, and there are high trading costs. So in that, it's not that compared to cost. Okay. Furthermore, we find that the anomalous return with value-weighted portfolio largely eliminated when omitting low-priced stock. Okay, it is even news. Okay, such pattern is concentrated in low-priced cheap stocks. So if we get rid of those cheap stocks, and if we have a large good stock, then this pattern doesn't appear. Something. And those low price stocks are hard to trade usually, hard to get. So it is really bad. And are not at all priced with an equal weighted portfolio. Okay. Value weighted portfolio, equal weighted portfolio means that in equal weight portfolio, you buy every stock in the same amount. $1 for Samsung, $1 for LG, $1 for Hynix. In value-added portfolio, since Samsung is great, you invest in $2 in Samsung, $1 in Hynix, and 1 cent in some very small stock, something like that. It's a value-added portfolio. By the way, in finance, we always argue that idiosyncratic risk doesn't matter. Okay? Right? Only systematic risk matters in finance, right? Because idiosyncratic risk, something like this, will disappear in very large portfolio, right? So we say idiosyncratic risk doesn't matter, but in reality, that is like ideal theoretical word. But in reality, actually idiosyncratic risk can matter. For example, Merton offers an explanation for why investors would demand high return for taking on higher idiosyncratic risk or idiosyncratic volatility, IVOL. Okay, he explains that IVOL would be positively related to the expected return when investor cannot fully diversify their portfolio. Right? In theory, we argue that we can completely diversify away idiosyncratic risk. That's why idiosyncratic risk doesn't matter. But in reality, because we cannot completely diversify it away, idiosyncratic risk may matter. But even in this case, right, if it matters, if it is high, volatility of this one is high, it should affect this one high, right? But in reality, in idiosyncratic low volatility, it is the other way. So that's why it is puzzle. Even if idiosyncratic risk matters, because of the risk relationship and our common sense, high risk should generate high future return. But again, in our low volatility anomaly, it is the other way of what Morton thought. That's the interesting part. Specifically, they show that and then some people trying to explain why stocks with high idiosyncratic volatility may affect future return, right? For example, some scholars show that abnormal return generated by idiosyncratic volatility-based portfolio strategies in international market strongly co-move with those in the U.S. market, suggestive of a common risk factor. Okay, it is a good argument, right? If there is some hidden factor that moves every stock together, then by definition it is a systematic factor, right? Because we cannot diversify away by simply holding large stock because that hidden factor moves everything together, right? So there is a systematic risk. In addition, they argue that systematic risk is somehow correlated with idiosyncratic volatility, low volatility, anomaly thing. In that case, even though each individual that idiosyncratic volatility may look like idiosyncratic risk, but if it is, it may signal some hidden systematic factor. In that case, it should affect future stock return, and it is consistent with our finance theory. Right? It is basically their argument. They state that the large commonality, okay, co-movement, in the co-movement suggests that broad, not easily diversifiable factors lie behind this effect. That's what they say. It looks like idiosyncratic risk affects stock return, looks like this, rejecting our finance theory, but in reality, that relationship between idiosyncratic risk and future return captures some co-movement of every stock. In that case, it's risk. The large commonality in common suggests the broad, not easily diversifiable factors lie behind these effects. The co-movement findings suggest that the return predictive power of idiosyncratic risk is likely due to some pervasive risk factors. Clark et al. As well argue that idiosyncratic volatility and total volatility should be seriously considered as an additional equity market risk factor, like this one. Okay. That they argue that we should add something B5 IVOR, something like that. It's seriously considered as an additional equity market risk factor that investors should incorporate in portfolio. Okay. But again, even if their argument is right, still okay, so if this argument is right, then the empirical evidence in that run counter Burton's prediction, okay? Even if their argument is right, it is still strange that why seemingly intuitive high risk predict low future return. Still it is kind of puzzling because it run counter to Burton's argument and our common sense, right? They provide good explanation, but why? Why that co-movement or systematic factor is related in weird way, such that high variability predicts low future return? It is still puzzling. So we don't know. The answer is that scholars don't know yet why that pattern happens. And then, of course, Black focus on market beta, this one. Black offers a theoretically consistent interpretation of why low risk stock might do so well relative to high risk stock. So Black provides some explanation. Okay, he argued that borrowing such as margin requirement might cause low beta stock to outperform. Okay, because they have a low finance cost of borrowing that. More recently, Wiggler et al. Proposed that behavioral considerations, okay, including the structure of institutional clients' mandate, discourage arbitrage activity that would otherwise eliminate the low volatility effects. So they argue that there is a behavioral, psychological, some explanation about that. The Black and Wiggler et al. Explanation may provide insight into why the low volatility effect continues to persist for so many years despite being highly recognized. Okay. So they argue that, this is something we have known long time. Okay. High variability stock predicts low return, and low variability stock good performance in future. That is something we know for long time. It is even more puzzling because if for long time and simple trading cost, it is very easy to implement simple trading cost of buying this stock and selling this high variable stock. This is obvious strategy and everyone can do that. But even that is true. Okay, if even though, so it means that it is such an easy trading strategy, and people have known this such a long time, but it is very strange that such trading profits still persist. Okay, such anomalies still persist. It is very strange. Why people just don't try it away? Okay, and why there is still other money outside on the table? That's very strange because we saw that money on the table such a long time, and why it is still there? This basically that argument. Now, data and sample, they collect the good data. So now they started their empirical investigation. We concentrate on idiosyncratic measure relative to pharma French three-factor model. First, we have to define which stock is like this and which stock is like this, right? Of course, good ways we can simply take a look at their past performance. But they, of course, it is academic paper, so they use quite more sophisticated method. They basically run this model, okay? They collect past stock return data, and they did some statistical analysis as get rid of this part, and they simply collected this part, okay? That's what I did. And then, after collecting this part, if this one moves a lot, it is a highly volatile stock. If this term moves slightly, it's low volatility stock. That's what they did. We concentrate on idiosyncratic risk measured relative to pharma French three-factor model. Specifically, we measure IVOL as the standard deviation of the residual. This is called residual. Something remains after we control this part. We measure IVOL as the standard deviation of the residuals from the pharma French three-factor model by regression analysis. So daily return of the individual stock in excess of the 1 month TV rate. 1 month TV rate is risk-free rate RIT minus RFT. So exactly this one. Regress this one on the daily returns to common factor relative to the size booked market and market. Something like that. In other words, for each stock I, we perform the following time series regression. Right? Same one, right? They actually don't take into account this one. They only up to this part. It is called the pharma French three-factor. 1, 2, 3. In academia, 4-factor model is more popular. 1, 2, 3, 4. But in this paper, they use only factor. But still, it is top standard than what industry people use. This one. And then we measure, so they use daily return. Okay. First, they measure this on another 3 ways. For the first 1 month, for every day, they calculate 1 month's daily return and calculate this. That's method 1. Method 2 is, now instead of using daily return, they use monthly excess return. So they collect like a 36 past month, 3-year data. So it is 3 years, so 12 months, so 36 months data. Or they 5-year data, which means 6 months data. And so they use monthly return, and they also calculate this one. And they define as IVOL 36 and IVOL 60 once they use monthly return instead of daily return. Okay, still there is a pharma French factor. And then they also, instead of pharma French three factor, they also use just capital asset pricing model, and also they try to measure this one and they check whether the result changes as they change the definition of idiosyncratic risk. They also run this one. Okay. So I mean, they tried all different way of measuring the variability, and they see whether their results remain same, whatever definition they use about this idiosyncratic part. So N1, 36, 60. And then now, okay, their research question, okay, now they have a method of measuring variability, right? Daily data, 60 months data, or 36 months data. Okay. Now they have to measure the transaction cost, right? Cost of trading, or more broadly speaking, they use measure of liquidity, how it is easy to trade. We explore the efficacy of eyeball trade. Okay, so how they measure liquidity. Whether liquidity, again, liquidity is important because it tells whether this trading strategy is implementable or not. Okay, so what is their measure of liquidity? They use very intuitive liquidity measures. For our first measure, we use the average stock price in months. Very simple. How expensive a stock is. So they argue that the more expensive a stock is, it is more liquid, or it's easier to trade. The cheaper a stock is, it is more difficult to trade. Does it make sense? I mean, our common sense is that something cheap is easier to trade, right? But in stock market, it's not true. Expensive stock is easier to trade, actually. Why is that? It is because of structural bid-ask spread. Whenever you buy and sell, that cost is like fixed, in some sense, fixed per trade. So if a stock is very expensive, the cost of trading is small fraction, right? If it is cheap, the small payment occupy a large amount, right? So again, Wolf of Wall Street, they buy and sell Leonardo DiCaprio and their fraudulent fellows, okay, sell very cheap stock, penny stock, okay, like $1 stock. But whenever they sell and buy $1 stock, they charge like 25 cents per trade. 25 cents, seemingly very cheap, nothing, but it is 25%. Something like that. You know, in academic, it is well known that stocks with market value of less than so stocks possess meaningfully less liquidity in proportion and are subject to market manipulation versus non-penny stock. There are a bunch of research about that. Okay, so exactly Wolf of Wall Street manipulation. Okay, that's why you have to see the movie. It is very, very fun and very fun. How people are corrupt, what corrupt people do. And how financial institution corrupt independent of the personal corruptions. Excellent movie. And for our second, so that's the liquidity measure one. Another, but it is not the only liquidity measure they use. They use another liquidity measure called, we practice transaction cost such as bid-ask spread and commission as a proportion of trading value with non-zero returns. So in some stock price doesn't move. Like Samsung Electronics, stock price move every day. But in small stocks or unknown stocks, sometimes the stock price remains same for several days, right? It means that people don't trade. If stock price remains same, It is not likely if people are trading, it means it is not trading. So it's non-zero. So if it's another zero return period, non-trading, like non-price moving days, it is not liquid stock in some sense. We measure the incidence of non-zero returns as the percentage of days during the prior month that a stock is going a non-zero return, non-zero. The idea behind the non is that it is intuitive. Liquidity with a high transaction cost and thus low liquidity will have less price movement and more frequent zero return days than a security with low transaction cost and thus higher level of liquidity. That's very common sense. The underlying premise is that they kindly even explained it. The marginal trader will only trade when benefit of trading is greater than benefit of not trading, right? When the marginal benefit of information signal exceeds the cost of trading, then they will trade. So if cost is high, which means liquidity is low, they are not likely to trade. In that case, price is not likely to move. Otherwise, the security experiences zero return. In short, non-zero will have taken a smaller value for low level of liquidity. Makes sense, right? Then our third measure. Their third measure, we proxy for the ease in which arbitrager can accumulate and liquidate trading position. Here with dollar volume defined by product of daily closing share price and the share volume. Simply the trading volume. They go to the each stock and they check how many people, how much people traded for the last 1 month. If it is high, it means people trade a lot. It is likely they are like liquid stock. It means that if the market is active for a particular stock, then they can easily sell or buy the stock. So it is high liquidity. So this third measure is the most like obvious way of measuring liquidity. And then in industry, actually, when people say liquidity, many people usually say it's trading volume. And then my favorite measure, finally, Amihud. Amihud illiquidity measure. A scholar called Amihud developed a formula to check liquidity. It's very easy and powerful one. Okay. For each stock, they calculate this Amihud measure, 1/T million absolute of return and price of volume. If this number is high, Amihud says that the stock is not liquid. T is basically trading day. T is trading day or non-zero trading day. Okay? Well, T is a positive volume trading day with a month of measure calculated. Okay? Note that a high value of Amihud, okay, if this is high, means that it is high illiquidity because a particular dollar volume traded is associated with relatively high price movement. If this one is high, it means that whenever people buy or sell, it generates high price movement. It is the measure of market impact. If market is not liquid, market is not active, whenever I try to buy something, my own demand affects the market price, right? Because people don't trade. So whenever I try to buy something, suddenly stock price move up because of my demand. Whenever I try to sell, stock price goes down because of my own supply. So it hurt my trade. Right? If market is, that's the exactly how much I hurt because of my own trade. There is a measure of illiquidity called market impact. So this Amihud measure of market liquidity, market illiquidity. Okay. So anyway, we calculated. They calculate all our. So we have a four way of measuring transaction cost, right? We calculate all our measure of expected transaction cost during the same month in which our beta is measured. Table 1 presents a summary statistics for our measure. Where is summary 1? Let me open another another window. 여기를 보면 이 사람들은 아미우드에 한 달 기준으로 했을 거야. 한 달 아마 지난 한 달 동안 뭐 이걸로 한 걸로. 정확한 숫자를 보면 여기 나오겠지만. Let's go table 1. Table 1 summary statistic known as again. summary statistic 설명이 있나? 없네. 아마 한 달일 거예요. 한 달. 한 달 기준으로. 네. 가격이 여기 있네. 그러니까 아미우드 매저를 보니까 어디 보자. 아미우드를 보니까 summary statistics average 아미우드가 이건 코릴레이션. 그래서 아미우드 매저를 보면 민이 약 6.54. 그래서 스탠다드 데비에이션이 이렇게 나왔네요. 퀀타일 뭐 25, 하위 25%, 상위 25%. 네, 미디안이고 이렇게 나왔네요. 네. 이게 테이블 1이고. 네. 테이블 1이 summary statistics. So summary statistics. Let's take a look at summary statistics. So interestingly, okay. By the way, if we have measure of price. So 1, 2, 3, 4. They are four measure of the liquidity, right? Four measure of liquidity, and then interestingly, the four measure of liquidity are not so strongly correlated each other, right? If we wanna take a look at correlation between two, we take a look at this part, and correlation is like less than 10%. It means that they are all measure liquidity or transaction cost, but they measure different dimension of transaction cost. That is good news. Okay. So when we say transaction cost or liquidity, it is not single dimensional concept. It is multi-dimensional concept. Okay. Whenever we say a stock is illiquid, we can ask, okay, from what perspective? Amount or trading volume or non-zero or price. And then table 2 is the abnormal return for idiosyncratic volatility based portfolio. 이거 불편하네 이렇게 크로잉. 이렇게 일단 넘어가서. So in the table 2 shows the average alpha associated with each quintile portfolio. Okay, so let's go table 2. Okay. So in table 2 is abnormal returns for idiosyncratic volatility based portfolio, monthly regression of eyeball quintile portfolio return. Okay. So table 2 reports the coefficient estimate for the intercept of the pharma franchise three-factor model. So number in this table is now they add alpha, the pure money part. Okay, they report this part. Okay, intercept of the pharma franchise three-factor model in percentage. The dependent variables are monthly excess return of valuated quintile portfolio formed monthly by assigning firm into quintile based on a magnitude eyeball. Okay, so dependent variable is quintile portfolio. So every stock in the economy we make the 5 groups. Okay. So basically, we sort the stock based on the size of the idiosyncratic volatility, from number 1 to some like 100,000, right? And once we sorted, we make it 5 groups: top 20% to next 20%. And each quintile they quintile portfolio, they use this one, they calculate this one and use that as a dependent variable. Okay. Minus IBOR is computed monthly as a idiosyncratic volatility in regression of daily excess return of 500 factor minimum 70 observation. Okay, in this case, they show only daily, monthly regression. So when they sort stock based on IBOR, they use a previous 1 month data or daily return in this case. Okay, so instead of IBOR 36, IBOR 60, they use monthly daily one for this one. And then we relate IBOR in month T with stock return in future. It means that every month they measure IBOR of past 1 month, how much they move for the last 1 month. And then once they go to the stock, then for each sort they want to take a look at the future return, right? That's our purpose, right? Once we have information about variability, we want to see how they change in future, right? So they relate it into future. So when we sort the stock at time t, we take a look at return from t to t plus 1 to t plus 2, t plus 3, t plus 12, 1 month later. No, 12 months later. Right? So they are all future. Yes? Oh, yes. So how we know? So I mean, we do basically for each month in the past, we assume we are at a particular time. Okay, and we sort the stock. So for example, today the March. Okay, March 24th. So let's assume that we go back like 1 year ago, year 2003, March 24. March 20, something like that. And at the 1 year ago, we are assuming we are at that day. And then from that day, and we go again for the last 1 month, previous 1 month, which is the year 2003 of February, right? February. And then we calculate data variability for the last 1 month from March to February. And then we are taking a look at what was the return of the from March 20 to April 20, something like that. Then May, and then this is the June, and this is from until today, right? So we do this kind of experiment for every period in the past. Of course, we cannot do analysis right now because we don't know what's going to happen in the future, right? But in the past, we can do that kind of analysis at a particular time, right? That's exactly what they do. Good question. So we relate IBOR as month T, T is the past, to the future return from the perspective of that past. So still we have the data, right? So stock returns adjusted for crisp. Dividend should be calculated in calculating future returns, right? And some stocks go listed, right? 상장 폐지, okay? minus 100% return. We take into account that. And then from 1 to 5. What is 1, 5? Anyway, okay. So it is a quintile portfolio. So we have 5 groups, right? So we have 1, 2, 3, 4, 5. So 1 corresponds to quintile form with lowest IBOR characteristic. So 1 is the group of stock with like this one. And then 5 corresponds to the highest IBOR characteristic. So 5 is like this. So 1 minus 5 is the difference portfolio. Long short portfolio means that we take long position. We buy stock with like this one. 5, and then we take short position, selling position for stock with like this one. So 1 minus 5. corresponds to quintile firms with the highest IBOR. No. 1-5 is difference portfolio between the lowest and highest ranked quintile portfolio or quintile spread portfolio. In the previous class, we take long position of a high tax surprise portfolio. We take short position low tax surprise portfolio, right? Something like that. Exactly similar one. Instead of tax surprise, we do this with the size of the variability. Heteroscattered constant. So T statistic, this one is something called the numbers in parentheses. T statistic, like a Z value in the high school statistics. Z is more than 2, like a significant, something like that. But anyway, the number in this parenthesis, if it is greater than 2, it means these numbers are statistically significant. Like in 5%, 1%, something like that. So when you calculate this one, it is not simple Z value, so it is heteroscedastic consistent T statistic. Something cool, okay? You don't have to know this, but it's something cool measure. Okay? Measuring the significance of excess return. So we don't know this, it is cool. Whenever it is greater than 2, it is 5. Star, 3 star, 2 star, 1 star indicate significant at 1, 5, 10% level. It is significant at 99%. You know, you learn all this, right, in high school. 1% is like 2.3 something, normal distribution, something like that. The more star, the more strong. And then this is very interesting, right? So let's take month 1, okay? We suppose at a particular period in the previous month, okay, we calculate variability for the past 1 month, and then we sort the stock and make it 5 group, and we will see how the performance of the each group for the next T plus 1. And this is a typical anomaly, okay? This one is low, okay? Low number is low variability stock, right? This one, about this pure money part, this one is small, okay? No, this one is like 0.08, but stocks with large variability is strong negative, which means that we have high this one, then alpha tends to low, which means that high risk, low return. Exactly the strange phenomenon which we call low volatility anomaly. This is certainly no. So if we take long position of this one and short position of this one, the performance is simply this one minus this one, right? So it is 1.19% per month. Right? So if we use that strategy, it is monthly one more than return. So per year, it is like a 13% excess return. So it is huge. Right? But then we have interesting question. If we don't change the suppose, so we measure, we sort the stock based on variability, and then we make a top 5 group, and then let's hold exactly to order, and let's gonna happen what happened in the next month, and then next month, and next month, and for the 1 year. It is like a long-term performance from here. And long-term performance, it seems that excess return part is going down and down, weaker and weaker. In this case, again, this one stock with low volatility high, but now stock with high volatility. In the previous case, high risk, low return, but now that low return is not statistically significant anymore. Okay. So in addition, in this case, this one is largest, next largest, and third largest, smallest, right? But now the order is beginning to change. This is the large, but this one is even larger. This one is even more larger. And now suddenly drop. They are statistically not significant. Now the order is changing. In month 3, again, this high variability is still insignificant. But now this low volatility is still positive, but they are not exactly ordered. Okay, so the order is destroyed. Now long short portfolio, taking long position of this one, short position of this one. This one is large positive. Month 2, that begin to decrease, and this one is even statistically insignificant. And 1 year later, it is significantly insignificant. So it means that when you want to make money based on low volatility anomaly, we can use that strategy only 1 month. Okay, only 1 month. Only for the next 1 month, the order remains strong. Okay, which means that if you want to make money and sort the stock, calculate variability, and sort the stock, make a portfolio, you have to trade every month. Every month now, okay, we know the valid period. This strategy remains valid for only 1 month. So every month we have to calculate, we have to sort the stock again based on variability, which means that we have to calculate variability again every month. So whenever we calculate again and again, the order changes. So we have to change the order, and we have to change the quintile portfolio again, right? That requires us to trade every month. This is not a good news, right? Because we have to trade every month, which means that we have to pay trading fee every month. It is not good news, okay? And then the next natural question is, since we have to trade every month in order to make money, trading is now a big issue. And the question is, then how much we have to pay for the trading? Okay? That's the next question. In order to answer that question, the previous we define 4 measures of liquidity, right? And then we will relate that 4 measures of liquidity with this trading profit, which remain valid for the only 1 month. Okay, this is table 3. So empirically, then the excess return action surrounding eyeball anomaly all occurs in the first month or 2 months. So minimum, so 1 month or maximum only 2 months, right? This is exactly the result we just showed. Okay. In short, we find that the eyeball effect is short-lived, effectively requiring traders to adjust portfolio holdings at least every other month to have a reasonable chance at producing alpha. That's what I told you just before. Such frequent rebalancing naturally raises the question about the impact of transaction cost and liquidity constraint. Since we have to trade every month, then how much we have to pay every month, right? And then we know how to calculate that because we have a 4 measure of the liquidity. Okay. Done. Okay. Table 3A. Abnormal returns for low-risk based portfolio, monthly regression of zero-cost quintile portfolio return for month T plus M. Okay, so month T plus M, T plus 1 month later, 2 months later, 3 months later, something like that. Table 3A reports the coefficient estimate of the intercept of Fama-Frenchy 3-factor model in percentage. Again, the numbers in the table is this one. The dependent variables are same. The monthly excess return of the equally weighted and value weighted quintile portfolio owned monthly, so every month, by assigning firm into quintiles based on the magnitude of respective risk characteristic, IBOR 36, and beta. So in the previous table, we only calculate IBOR, now they calculate IBOR 36. We relate each risk characteristic in month T with stock return in future months. So at time T, we sort the stock, make a portfolio, and take a look at their performance for the next month, next month, 1 year. And stock returns adjusted for, again, dividend and delisting returns are from CRISP. Now we have 1 to 5, 1 minus 5. 1 minus 5 is same. It's the difference portfolio between the lowest and highest linked quintile portfolio or quintile spread portfolio. 1 minus 5 is therefore we take long position of the low value of stock and short position of high value of stock. 1 minus 5. And then heteros number in parentheses, again the cool way, cool measure. The T means heterostaticity constant, T staticity. If it is greater than 2, it is good. Less than 2, it is not good. The most better, the better the result, stronger the result. Data are from this one. Okay. So again, the evaluated 1 minus 1.19. This number is exactly the same to this number. Okay, 1919. Now we put only this one. So it is evaluated portfolio. And then we can also calculate equal weighted portfolio. And if we calculate the equal weighted portfolio, the result is much weaker, right? And then T plus 2, 0.77%. This one is same to this number. Valued. But in the weaker rate, this one is simply quickly goes away, right? So lesson number 1. If we want to make money, we have to make a valuated portfolio instead of equal rate. In addition, as time goes by, it becomes weaker and weaker. So again, this one says that our trading strategy remains valid for just 1 month. And this one says that zero cost. Okay. Now, this time, let's get rid of stock, which is penny stocks. We get rid of penny stocks, and so which means that we get rid of stock which are hard to trade. Stock that is hard to make trading strategy with. Once we get rid of the penny stock, and we have good stock, and using that liquid good stock, again we sort the stock, make 5 groups, something like that. And then once we make this, first the equal weighted portfolio, now it is negative, not positive anymore. Right? So that abnormal low volatility anomaly disappear. Right? Disappear once we get rid of the penny stock, because they are all negative. Even in valuated stock, this result is much weaker. It was 1.19%, but now it is just 1/3, less than half. The size is weaker. So it means that if we get rid of penny stock, then the low risk anomaly disappear, which means that it is likely that the low risk anomaly is concentrated in the stock with low liquidity. Stock which is actually hard to trade. Okay. Well, we can check whether our results remain same if we change our measure of measuring this one. Okay, the result does not change much. IBOR 36. Again, this result is stronger than this result, right? And still the valid period for this trading strategy now just 1 month. Okay, so this is weaker, and then this is weaker, and then if we carry the penny stock equal rate, it is actually negative, high risk, high return, which is consistent with our intuition that anomaly disappear. And in the valuated portfolio, any pattern arises. If we use beta, so stock with beta, well, we cannot find any pattern. Actually, in this case, we have star in the negative star, so it is negative, which means that high risk stock actually generate high return, which is not anomaly at all, right? It is a natural result. So this result, this part shows that, well, once we get rid of cheap penny stock, there's no more anomaly. Especially in equally weighted portfolio, we have low risk stock generate low return, high risk stock simply generate high return, right? Nothing surprising. If it is positive, it is anomaly, but now it is negative, so it is not anomaly at all. So it is very interesting result. Okay. First, Results for average alphas are somewhat weaker when using equally weighted portfolio of finding consistent across all time periods across all risk definition, IVOR 36 or better. And second, the observed zero cost alpha monotonically declines rapidly during succeeding months after portfolio formation for all major risk. Current month's risk has no meaningful relationship with stock return in the period beyond second month. So that trading strategy valid just 1 month. Third, our alternative definition of volatility, like IVOR 36 beta, generally presents somewhat reduced average alpha versus IVOR for both value-weighted and equal-weighted portfolio. And then these results are shown in the table column by heading stock price less than 5 excluded. So the result, what would happen if we get rid of the penny stock? When excluding penny stocks, one proxy indicator of liquidity, portfolio alpha is meaningfully reduced across all board, right? This size is lower than this one, or even negative, right? Meaningfully decrease that anomaly. Now let's go to table 4. Estimating arbitrary cost for idiosyncratic volatility anomaly. Let's go to table 4. Table 3A. Table 3B. Oh, table 3B is similar. Okay. So zero cost, equal rate, value rate. Zero cost. So again, if we use value rate, this is larger slightly, right? But it disappears, become less and less as time. So the valid period is just 1 month. Now table 4. Abnormal returns for idiosyncratic volatility based portfolio. Table 4 refers the coefficient estimate intercept of the Farmer Francis effect model in percent. Again, the alpha term. Again, same to previous. The dependent variables are the monthly excess returns of the value-weighted quintile portfolios formed monthly by assigning firms into quintile based on the magnitude of IVOR. And the IVOR is computed monthly as the idiosyncratic volatility in regression of the daily excess return of the Farmer Francis 3-factor. Same, okay? And then we relate IVOR in month T with the stock return in month T plus 1. Stock returns adjusted for dividend and deletion results are from CRISP same. Now again, 1 to 5. We have 1, 2, 3, 4, 5. 1, 5 correspond to quintile firms with the lowest or highest IVOR characteristics respectively, and this 1 minus 5 is the long short portfolio. It is a difference portfolio between the lowest and highest ranked quintile portfolio or quintile spread portfolio. And the number in the parentheses are again the T statistic, heteroscedastic, consistent T statistic. And the 3 star, 2 star, 1 star again indicates a significant at 1%, 5%, 10% levels respectively. And the data are from 1963 or 2010. Now these are liquidity model. Average price, the average daily stock price in month T. I told you, the higher stock price actually is easier to sold or sell or buy, right? High stock price means higher liquidity stock. And then average non-zero R is average proportion of daily stock return that are not zero in month T. Average DVOR is the average of monthly sum of daily product closing price and share volume. Average AMI-hood is the average monthly average of AMI-hood measure of illiquidity. Now it is very interesting. Okay, again this one, low number is like low variability stock, high number is highly variability stock. First, average price. It means that stock with low variability is expensive stock. Okay, so it is loaded like this. So stock with highly variable stock are in fact the stock is hard to trade. illiquid stocks tend to move like this. And average non-zero. Okay. So for stock with low variability, non-zero day, stock price actually non-moving, percentage is high. Okay. Percentage high, no, is low, but stock with actually this one is actually going up, and then go down. So in terms of non-zero days, actually there is no meaningful pattern across stock. So this is uninteresting one. So in terms from the perspective of this liquidity measure, the ordering of stock based on variability is not that related to each other. But my favorite measure, amihud, is this is smallest, this is huge, right? So this result and this result is consistent. It means that stock with high variability is high amihud measure, which means highly illiquid. Market impact is huge. And then this is a result again consistent. Stock with high low variability has high trading volume. This market is active. Stock with a lot of variation has, in fact, low liquidity. So except this one, these three measures are consistent. Low liquid, high liquid. And about this one, actually non-zero, this one is in some sense intuitive. This one shouldn't be that related because if we take a look at the other ones, basically this one means we basically sort the stock based on variability, right? If stock is not that much, it means that stock is not that moving. So in some sense, those stock is likely to less move, right? Which is likely to include more non-zero, more zero trading volume or zero movement, right? So by construction, it is natural that those stock is likely to less move, therefore that's likely to include more zero return days. Right? So this one is in such an understandable. But except this one, these three measures are all consistent. So it means that the low volatility anomaly we investigating is highly, in some sense, captures that variable captured actually not anomaly, but actually the liquidity of the stocks. Table 5. Overall, about table 4, overall, our findings suggest a close positive association between IBOR and liquidity. Interestingly, we find the average price of 7.03 for those stocks in high value quintile, which suggests that many stocks in the highest quintile portfolio would be considered penny stock, right? Take a look at the average price like this. Highly variable stock, the average price is 14, and then about they argue that average price is 703 for those in highest variable quintile. Average price is it different? Oh, okay, so no, they didn't include. So if they include all the penny stocks, this one drops to 7. So in fact, highly variable stock with high variability is likely to be penny stocks. Stocks actually harder to trade. Okay. So in table 5, how many tables we have? Table 5, we just saw table 5, and table 6, 7. Okay, we have only 2 more tables. They tell you similar results. In table 6, idiosyncratic volatility based value portfolio alpha and liquidity. It is again monthly regression of IBOR entire portfolio grouped by high, mid, low liquidity. Okay. Some descriptions as in previous table, same description as previous table, and DVOL sort follow and where each month stocks are sorted in 3 groups based on DVOL. and with each tensile, so three group, it is not quintile, it is tensile. So stacks are sorted in quintile based on ivor. Okay. So again, this is small variable at stack. 5 is highly variable stack. 1 minus 5 is take long position, short position. This one, and then result is the t plus 1 with the top. This is something we know. Okay. Return high variability, low return. So it is something called again is low volatility anomaly. Okay, this is low volatility anomaly. Now, what they did is for each group, each group. Okay. Now actually they did it this way. So for entire portfolio, entire stock, they first classified into three groups. Stock with low trading volume, stock with middle trading volume, stock with high trading volume, illiquid stock, middle liquid stock, highly liquid stock. And in each three group, they again develop five subgroups based on the variability. So this one is low liquidity stock but with low variability. This stock is low liquidity stock, low trading volume, but highly volatile stock. And this one is a high malleable liquidity, highly active market, and then low variability stock. This one is highly liquid stock, high trading volume, and then high variability. The very interesting pattern is there. Okay? The very interesting pattern is there. Very interesting what is there. Okay. For the low stocks with low trading volume, stocks with low liquidity stock, where we have very strong low volatility anomaly. In the low liquidity stock, safe stock generate low return, and as stocks becomes more variable, more risky, the return becomes bigger and bigger and bigger. This alpha becomes bigger and bigger and bigger. So the low anomaly pattern is strong in liquid stock. Okay, right? Low liquid stock, right? Very strong, right? And then, right? No, it is not that one. I'm confused. 0, 1, 2, 4. Yeah, it is actually the other way, right? It is the other way. Actually, it's the other way. This is the lowest and this is the highest, right? So it's the other way. So actually, in the stock with low trading volume, this pattern is exactly the opposite, right? And in the stock highly devor, okay, or is in the stock high devor, I think it is dollar volume. Let me check the definition of devor. Table 6. I'm suddenly confused. So eyeball, quintile length test. But now we just separate liquidity tensile, low liquidity, devor, right? For this analysis, stocks are sorted tensile. Column 2, 3 shows no profitability. Okay. 2, 3, no profitability of 1. Universal low is average excess return for high liquidity group shown in concept indicated quintile report will signal. Okay, column 4 shows that 1, 2, 3, shows that eyeball related abnormal return for value and portfolio decline significant decline by 60% when considering portfolio with sufficient liquid position. I think this is higher. In the last column tables, eyeball alpha is a more specifically first group returns in liquidity side and it is average. Anyway, I got it. So it's a bit strange, but what they say is that now this is important part. They get rid of penny stock, right? Penny, and they find again, and then they sort the stock into three group, and then low volatility. Okay, in the previous slide, we argued the low volatility anomaly is concentrated in the stock with very low liquidity or very cheap stock, right? And we get rid of this one. We get rid of that one. And then we have low trading volume stock, but it is but still decent one because we get rid of stock with a very penny stock, very cheap one. And in that case, in the previous case, we saw that low volatility anomaly occurs in the low liquidity stock, but even in the low liquidity stock, that pattern doesn't appear anymore because it is negative. And if we have high risk, then you have high return, right? So that pattern disappears even in the low liquidity stock. Once get rid of very strange penny stock, right? And this one has no pattern. Only in the stock or the high volatility or stock with some liquidity, and then only in this group, this pattern arises. But again, this is much weaker than previous 1.19%. That's the result. And table 7. The table 7 is idiosyncratic volatility-based portfolio. Okay, this is same. So in this case, we now classify stock with low amount, mid amount, high amount stock. And high amount stock is a very illiquid stock. This one is a liquid stock. It is in the middle, right? Again, once we get rid of this penny stock, then in the high amount stock, low liquidity stock, we have this opposite pattern. High risk, high return pattern, right? So it is negative, not positive anymore. Right? So if we get rid of penny stock, even in the low liquidity stock, we still cannot find low volatility anomaly. Low volatility anomaly weakly appears in the very low amount stock, which suggested our well-known low volatility anomaly is present only. That kind of anomaly occurs only because of the penny stocks, which is actually hard to trade, which means that it is actually hard to implement, hard to make money out of that low volatility anomaly. So table 7 indicates very similar result. Now discussion. I think this discussion part is very interesting. So let's read together. In our exploration of the low risk anomaly, over the full study period, we first find that various eyeball-based trading strategy we tested are profitable for the value-weighted portfolio only with frequently rebalancing and not profitable at all on average using beta as a measure of risk. So they find that again the low volatility anomaly present, and we can make money only with value added portfolio and only if we trade every month. Okay, every month. We further find that for the month IBOR-based rebalancing value-weighted portfolio, where potential alpha lies, the profitability of the zero-cost IBOR strategy is reduced by 6% more in the subsamples of stock with relatively low transaction costs and high liquidity. So once we get rid of, so even though that strategy may work in value-weighted portfolio and for the next only 1 month, even that profit disappear if we get rid of, or other part of this trading profit goes away if we take into account only non-penny stocks. This is in contrast to the finding. This is contrast to previous finding. Who finds that transaction costs have little impact on alpha, although they do not consider impact of penny stock. Okay? So they can argue that previous results are wrong. So low velocity anomaly is not that strong. Okay? We further find that since 1990, 1990, the alpha associated with low risk effect evaluated portfolio has disappeared within the more liquid universe penny stock. They didn't report this one. Specifically, in an unreported result, over 1991 to 2010, we find the insignificant zero-cost portfolio abnormal return of 0.24, T-stat 0.8, so it is less than 2. So risk period, they argue that even that trading profit disappeared. Additionally, when exploring equal weighted portfolio over all sample period, we find that any alpha associated with low risk effect is also completely eliminated within the subsample of stock with ample liquidity for trading purposes. The combined evidence from our measure of liquidity consistently suggests the meaningfully higher cost for arbitrageurs in attempting to exploit the low risk anomaly. In short, our finding casts some doubt. Actually, it's not some if they are humble. It's actually serious doubt on the practical profitability of a low risk trading strategy. For all these reasons, our results lead us to conclude that the documented 1 month low risk trading strategy has continued to exist to some extent due to the existence of a significant barrier to arbitrage, including transaction cost and liquidity cost. That money is in the table. That money is in the table for a long time because that money is hard to get. Okay? Because actually getting the money is costly behavior. We have to actually trade, and the trading is costly. So money is there. Not surprising. Right? These cost constraint arbitrageurs from fully eliminating the anomalous returns. Finally, the findings presented in this paper do not necessarily preclude the possibility of a profitable strategy associated with low risk. Clearly, there are other potential approaches. So they admit that in their strategy, they cannot find any trading profit, but there may be some smart, weird, complicated strategy that may capture the dollar on the table. They don't exclude that possibility. Clearly, there are other potential approaches to capture the low volatility effect, which may prove constructive in abstracting abnormal return. However, our paper is comprehensive, so they are comprehensive in its measure of risk, and as such, certainly raises important issues about implementing a successful low-risk arbitrage strategy in U.S. equity portfolio. We look forward to more research on this intriguing topic. And the conclusion, you can read the conclusion. Any question about today's lecture? Okay, this is enough for today, and let's see next week. Thank you.